Welcome to the Shakaama Live Show with your host, Shakaama. We're continuing on with our credit series. So today we're going to talk about credit score. A credit score is a statistical number that evaluates a customer's credit worthiness and is based on credit history. Lenders use credit score to evaluate the possibility that an individual will repay his or her debts. A person's credit score ranges from 300 to 850. And the higher the score, the more financially trustworthy a person is to be considered. The credit score model was created by the Fair Isaac Corporation, also known as FICO, and it is used by financial institutions. While there are credit scoring systems, the FICO score is by far the most commonly used. Consumers can possess high scores by maintaining a long history of paying their bills on time and keeping their debt low. A credit score plays a key role in a lender's decision to offer credit. People with scores below 640, for example, are generally considered to be subprime borrowers. Lending institutions often charge interest on subprime mortgages at a rate higher than a conventional mortgage in order to compensate themselves for carrying more risk. They may also require a shorter repayment term or a co-signer for borrowing with a low credit score. Conversely, a credit score of 700 or above is generally considered good and may result in the borrower receiving a lower interest rate, which results in them paying less money and interest over the life of the loan. A person's credit score may also determine the size of initial deposit required to obtain a smartphone, cable service, or utilities, or to rent an apartment. And lenders frequently receive borrower scores, especially when deciding whether to change an interest rate or credit limit on a credit card. While every creditor defines its own ranges for credit scores, for instance, many lenders think anything over 800 is excellent, here is an average FICO score range. So we start at poor. That's 300 to 579. Fair, 580 to 669. Good, 670 to 739. Very good, 740 to 799. Excellent is 800 to 850. So now the series is trying to get you to excellent credit score. I'm trying to teach you how to get there. Now the whole idea is to get you to an 850 credit score so that your entire life will change and you can see all of the benefits of playing the game. Let me say right here that your life will change. If you have never had an 850 credit score before, your life will change. You will see that you will actually live better if you have an 850 score. Now, there is a lot of people out there who will tell you negative stuff about the credit system, the credit scoring system. I'm here to tell you that the whole point of it is to absolutely make sure that you have good credit. They want you to have good credit. Why? Because that's how they make money, by offering you credit. Regardless of what you hear and how they use bad credit, those are vulture type of companies. For the most part, most companies are not vulture type companies. They make their money by offering you credit so that you can buy their stuff. That's offering you in-house credit or looking at your general credit, right? Now, let's take a look at credit score factors. There are three major credit reporting agencies in the United States: Experian, TransUnion, and Equifax, which report, update, and store consumers' credit histories. While there can be differences in the information collected by the three credit bureaus, there are 5 main factors evaluation when calculating a credit score. Number 1, payment history. Number 2, total amount owed. Number 3, length of credit history. Number 4, types of credit. Number 5, new credit. Payment history counts for 35% of a credit score and shows whether a person pays his obligations on time. Total amount owed counts for 30% and takes into account the percentage of credit available to a person that is currently being used, which is known as a credit utilization. Length of credit history accounts for 15%, with longer credit history being considered less risky, as there is more data to determine payment history. Types of credit used counts for 10% of a credit score and shows if a person has a mix of installment credit, such as car loans, mortgage loans, and revolving credit, such as credit cards. New credit also accounts for 10%, and it factors in how many new accounts a person has, how many new accounts they have applied for recently, which results in credit inquiries, and when the most recent account was opened. Now let's take a look at some insights from a CFP, Wilson David Investment Advisor, Aiken, South Carolina. I've never heard of Aiken, South Carolina, but if you have, please leave me a comment. If you have many credit cards and want to close some that you do not use, closing credit cards can indeed lower your score. Instead of closing them, gather up the cards you don't use, keep them in a safe place in separate labeled envelopes. Go online to access and check each of your cards. For each, ensure that there is no balance and that your address, email address, and other contact info are correct. Also, make sure that you have auto pay set up on any of them. In the section where you can have alerts, make sure you have email address or phone in there. Make it a point to regularly check that no fraudulent activity occurs on them, since you aren't going to use them. Set yourself a reminder to check them all every 6 months or every year to make sure there have been no changes on them and that nothing unusual has happened. And now here is a brief section on how to improve your credit score. When information is updated on the borrower's credit report, his or her credit score changes and can rise or fall based on the new information. Here are some ways a consumer can improve their credit score. Number 1, pay your bills on time. 6 months of on-time payments is required to see a noticeable difference on your score. 2, up your credit line. If you have credit card accounts, call and inquire about a credit increase. If your account is in good standing, you should be granted an increase in your credit limit. It is important not to spend this amount so that you have a lower credit utilization rate. So you want a bigger credit limit, but low utilization. They want to be able to see that you keep yourself in check when you do your spending. They don't want mass spending. Let me say this. I have never asked for credit increases. My credit card companies have all just increased my limits and sent me notifications that we increased your limit. And let me tell you, sometimes that happens 2 or 3 times a year. Of course, I didn't start out with that much, but I ended up with quite a bit. Number 3, don't close a credit card account. If you're not using a certain credit card, it is best to stop using it instead of closing the account. Depending on the age credit limit of a card, it can hurt your credit score if you close the account. Say for instance that you have $1,000 in debt and a $5,000 credit limit split evenly between 2 cards. As the account is, your credit utilization rate is 20%, right? Which is good. However, Closing one of the cards would put your credit utilization rate at 40%, which will negatively affect your score. Now, your credit score is one number that can cost or save you a lot of money in your lifetime. An excellent score can land you low interest rates, meaning you will pay less for any line of credit you take out, but it's up to you, the borrower, to make sure your credit remains strong so that you can have access to more opportunities to borrow if you need to. Now, I'm trying to allude to the fact that if you have a very, very high credit score, your entire life can change. You can have access to things that most people will never even know exist. Thank you for watching, and thank you for being a Patreon.